Okay, good morning, ladies and gentlemen. We've got about less than a minute before we officially start with the Bank of England prep with your host Tony with Macro Ace. Hopefully, everyone enjoyed last night's session or stream that I did with the FOMC. I know there was a big old surprise. It's a little bit of a surprise with a 75 base point hike rather than the expected 50. But as I said, we'll got about a couple of minutes or so, and then we're ready to get into it. But yeah, so a couple of minutes. Alrighty, okay. Let's get into it. We have some exciting stuff to kind of digest from last night and also this morning with the Swiss National Bank and their unexpected 50 base point hike rather than keeping the rates unchanged, and all the other bits of sentiment and what to expect from the Bank of England today as well. So let's get right into it. So the Bank of England. So with their interest rate decision. So what is it? So this is the Bank of England bank rate that the bank pays interest to commercial banks for holding their money with the Bank of England. Okay, and then wherever they set that rate, then of course those commercial banks will change that rate level to whatever they need it to be similarly around to where the interest rate or the current interest rate is at the moment. So that's what the bank rate is. And basically, of course, with the Bank of England, this is where they set their monetary policy and they have been providing more forward guidance as to where they expect economic policy to be, but they don't really do as much as the Federal Reserve does in regards to giving a lot of forward guidance. It's more so what is currently going on within the UK economy and what are the current risks to the economy, either to the upside or to the downside. So why is it important? So when you consider interest rates, as always, so with higher rates, it usually slows down growth, or to make sure it doesn't get too out of a hand, particularly with inflation being the Bank of England's key mandate of keeping it low towards the 2% target of inflation. That's the key thing of also making sure that the inflation rate doesn't get too out of hand or becomes unanchored, whether to the point where the Bank of England can't or hasn't got a handle of trying to keep inflationary pressures in check. So higher rates will, of course, boost or will increase the borrowing costs, increase the the amount of the mortgage that you'll pay back. And of course, if you're taking out a loan or you're paying back a loan, then of course that rate would that rate rise, that'll make it harder to do or more expensive to do. And of course, with low rates, whenever low rates are implemented or when you do see a rate cut, then that usually is to support or create growth and to try and bring up inflation too. If consumer spending or if spending has completely fallen off within the economy, then low rates would be used to try and bring that back up and to try and support that growth. So you'd see, so higher rates is what the lingo is usually used is when the central bank is hawkish, okay, when they fly really, really high, and dovish is when they're looking to support growth and looking to lower interest rates or provide quantitative easing in the economy as a dove. It flies lower than a hawk. So just to kind of bear in mind those key phrases then, hawks and doves, if you're not too sure about that already, well, hopefully should be now. But if we keep going on then, so as said, it affects banks handing out loans, mortgages, and credit, and the rates will be as we did see, it was back to pre-pandemic. We're getting back to pre-pandemic levels as well. Now, where is the economy at the moment? So, as I said, inflation has been the key sticking point for every central bank, okay, or most central banks. All of the developed countries' central banks have inflation as their key thing that they need to tackle at the moment. And the Federal Reserve, what they did yesterday, of course, they Powell cited that headline inflation is something that they do keep an eye out for, and it is something that they take into consideration, which is what they did. And he explained, of course, that the Federal Reserve's key way to measure inflation is using the PCE price index for forward guidance and where they expect inflation to be. But of course, he didn't say that they would. He did say that they would react quite quickly, and which is what they did when we had the surprise inflation report ticking up to 8.6 to a fresh 40-year high. But in the UK, so the unemployment rate is at 3.8%, so it ticked up from 3.7%. The employment change had seen an increase at 177k, with a prior of 83k. Inflation had jumped up by 2% to 9% from the prior of 7%. Okay. UK average weekly earnings as well. Again, talking about a wage spiral and whether or not wages are going too high, and if they're also getting out of control. So we'd seen that the year-on-year came in at 6.8%, lower than the prior of 7%. So this is quite key when you're talking about the cost of living standards, and is inflation really biting in to your to UK consumers' pockets? And we can see that just from the year-on-year figures alone, that inflation is eating into earnings of UK consumers. So that's something that's quite, of course, is very negative and leads to less spending within the economy, which in turn could lead to a scenario where you get a scenario of stagflation. Okay, so what I mean by stagflation is when there is a high rate of inflation, there is a high rate of unemployment, and GDP growth is low or in contractionary mode, i.e. we're in the negatives. We haven't seen that as of yet. Usually when we're looking at GDP figures and whether or not there is if the economy is within a recession, of course traders can kind of tell beforehand by the way that the central bank talks about where the economy is at the moment and where they expect it to be in the future, and of course spending patterns. But usually from an economist point of view, you're looking for at least 3 months or 3 quarters of negative GDP growth, I as in not in the plus, but I in like such as like -1 or further down. So that's one thing to consider as well when we're looking at GDP figures. So 2022, the first quarter came in at 0.8% versus a prior of 1.3%, so headed lower compared to the fourth quarter where we'd seen 1.3% growth. And GDP year-on-year prelim, we'd seen it was at 8.7% versus a prior of 6.6%. So better than last year when we got that data. But still, the quarter-on-quarter data is quite key to be aware of, that we are seeing a deceleration, or we're going backwards, and the economy was slightly weaker in the first quarter of 2022. Then, of course, as we'd seen beforehand, on May the 5th, the rates were lifted to 1%, a level last seen in 2009, to a 13-year high. Okay, and that was, of course, that left the Bank of England with little room to kind of hike interest rates. Of course, you have the impact of Brexit, high inflation. Commodity prices have skyrocketed. Fuel prices have skyrocketed because of the Ukraine-Russia conflict. But then you've also got to bear in mind that on top of that, Bank of England has got to worry about what other central banks are doing. And we'll get into that in a little bit more detail later on. But that's where the economy is at the moment. So that's what we need to just bear in mind. So on the previous Bank of England statement on May the 5th, so Haskell, Mann, and Saunders voted to raise the rate to 1.25%. So they were looking for a 50 base point hike rather than a 25 base point hike. Most MPC members think that some degree of further tightening in monetary policy may still be appropriate in the coming months. March, so the difference was that in March, they had said that some further modest tightening was appropriate, or would likely be appropriate. But then the change in the rhetoric and what's being said said that instead that we need to actually some degree of further tightening monetary policy may still be appropriate. This is one thing just to consider then. What's going to be the decision today? Does the Bank of England follow the Federal Reserve and also the Swiss National Bank, or keep more, or mainly the Federal Reserve and what they've done? But the Bank of England estimated GDP growth in the first quarter to be at 0.9%. Of course, that was the lower, or 0.8% in the first quarter of 2022. And in March, they had seen, they were expecting 0.75% quarter-on-quarter growth. So in March, they were more or less, if they kind of stuck to that, it would have been much better. It was slightly better than expected. But of course, their latest forecast, or the estimate for GDP growth, was slightly lower than expected. So inflation, of course, that is the key thing to be aware of. And what I want to do is just kind of go through what the comments had come through from the Bank of England from the monetary policy report, or the statement. So Bank of England, so the report showed the inflation peaking at an average of slightly over 10% in the fourth quarter of 2022. The March forecast was for that to peak at around 8% in April 2022. So of course that's flipped and changed to see sustained high levels of inflation. And they also said that UK inflation is likely to peak later and fall back later than in other countries due to the UK energy price cap. So of course they raise a price cap to allow those energy companies to raise it by 50%, which is a bit painful. But that's one of the key things, that of course the cost of living has gone up, and if you're paying more energy in your bills, then that has hurt. That has raised inflationary pressures because of those businesses that are taking the opportunity to be able to do that. Bank of England forecast shows that in 1 year's time, that the inflation rate will be at 6.65%. February forecast was for it to be around 5.2% based on market interest rates and modal forecast. Also, the forecast showed the inflation in 3 years' time at 1.3% versus a prior of 1.6%. And then in 2 years' time, they see it at 2.14% versus 2.15%. So even after, so 2 years' time, they still expect inflation. They would expect inflation to reach to near enough their target of 2% goal, right? That's where they see that's where they set their goal for inflation. The reason why it's 2% is because looking at what the Federal Reserve have said, and it's basically the same for other central banks, is that they say that first of all, 2% is where where inflation isn't out of hand, and there's healthy pickup in levels of prices, but it also isn't too low either. So it isn't too low enough for the central bank to say, okay, we need to cut rates or try and pump in some money into the economy via quantitative easing. So again, the key thing is that 2%, that's why the 2% target is chosen, also based off of past experience of what the Fed has seen and the Bank of England too. And everyone else kind of follows what the Federal Reserve does with their monetary policy to a degree in what they're focusing on and where they set their targets for. But 2% is their goal, the Bank of England. Then the Public Inflation Attitude Survey. So this, as it's in the name, is just gauging what the public thinks about where the rate of inflation is going to be, whether or not hikes are needed, or rates need to remain unchanged, or there needs to be a cut. But the median expectation is for over the coming year for that to be at 4.6%, up from 4.3% in February 22. So there's a tick up in expectation for inflation, inflationary pressures. Also, in regards to long term, in 5 years' time, respondents gave a median answer of 3.5% from a prior of 3.3% in February. So they're expecting that, of course, to tick up much higher or slightly higher, even after about 5 years. They're expecting inflationary pressures to remain quite high, again above the Bank of England's 2% goal. So 70% of respondents expected rates to rise over the next 12 months, up from 65% in February 2022. Also, just bearing in mind, if you are watching this live stream, then please do share it on your page, on your Twitter, with your friends who are interested in trading the Bank of England, who want to gain a better understanding. Don't forget to share the link with those guys as well. And of course, they could just click on the live YouTube link, and they won't have to do anything. They could just click it and watch, as always. No, there isn't any sign up required at all. But getting back to the inflation attitude survey. So when asked about what's best for the economy, so whether high interest rates, lower interest rates, or no change, 28% thought that rates should go up, unchanged from February 2022. 22% of respondents thought that interest rates should go down, which is up from 16% in February. And 28% thought that interest rates should stay where they are, down from 31% in February 2022. So I guess the key thing is, and it's obviously it's very obvious, is that a lot of the respondents are expecting that, saying it's better for rates to go up to dampen inflationary pressures, but you see this tick up in the response that inflation rates should go down. Again, this is the public's point of view, which surveys people from the age of 16 to 65 years old, right? So you're not going to get the best, you might not get the best response in total of the Bank of England saying, yeah, okay, this is what the public expects and this is what we're going to do. But it gives them a gauge, or it's just a gauge for them to kind of think, okay, maybe people, are going to be, they're going to feel some of the pain with high interest rates. So do we need to hike by that much? Maybe, maybe not. Do we need to hike by more, or should we do a rate cut, which is currently off the table at the moment. That's not what they've said they wanted to do. I showed you in the prior slide that I'd shown you there. But a lot of respondents, or you'd seen an uptick in respondents saying that they thought the rate should go down. Of course, there'll be less pain involved for what consumers, what the public thinks. But again, there's only 22% of respondents, up from 16%. Then, Bank of England member comments. So Tenrero said that over time, balance of risks are tipped to the inflationary side. Bank of England's Pill said that more needs to be done to transition from easing of the economy to help with COVID, Brexit, and the financial crisis. So just highlighting that we need to kind of be quick with our rate decisions, as they were at the very beginning. Okay, that they need to be able to take that action quickly to be able to rein in those inflationary pressures and to try and get back to a normal rate or a neutral rate of interest or interest rate as soon as they can. Ramsden has said that the Bank of England hasn't gone far enough on rate hikes on May the 12th. That was his comment there. And then Saunders, one of the members of the Bank of England, who actually said, or who actually voted for a stronger rate hike in the last meeting that we had. If we kind of keep going along then, so May 20th, we had Bank of England's Pill saying that with the independence the bank has, the Bank of England is able to take sometimes tough decisions. And yes, Paul Santos, I just saw your comment there that came through saying that due to Fed being hawkish, I believe the BoE will raise by 50 basis points. Majority of its GDP is really retail consumption, and therefore a weak pound not beneficial for the UK, in my opinion. So I think, considering what the Saudis did last night with the post, soon after the interest rate or the 75 basis point hike from the Federal Reserve, they hiked their rate by 50 basis points, right? Unannounced. But that was, of course, it's not a developed country. But when we look at developed countries, like the Swiss National Bank, they had hiked their interest rates by 50 basis points to 0.25%. So that was a surprise from the markets. And if I just bring up the reaction here for you, so you can kind of see how the Swiss franc reacted to that. So of course, if we're going, so of course there we go. So the prior rate was at 0.75%. At more or less historic lows with the interest rate. They had hardly changed their interest rates, at all, even when the Fed has started their tightening cycle. But because the Federal Reserve had taken into account the fresh 40-year high with inflation, and seeing that getting out of, potentially seeing the rate of inflation being unanchored and being out of control, and the Federal Reserve potentially losing some of that credibility, other central banks took that action from the Federal Reserve to try and rein in inflation as soon as they can, to the point where the Swiss National Bank had decided to take a 50 basis point hike. And so this was the market reaction here. I don't know if you can see that clearly. Hopefully you can. Let me zoom in. There we go. Okay, so there we are. So that was the market reaction. So the Swiss franc had strengthened off of that big old surprise from them. And then if we kind of look through the comments, a lot of it effective war and higher energy prices causing supply bottlenecks. That was the key thing that was mentioned from them. And that tighter monetary policy is aimed at preventing inflation from spreading more broadly to goods and services in Switzerland. So that is the key point there, that they took the reason as to why they took that very strong action. So what does that mean for the Bank of England then? Will they do the same, and will they decide to hike interest rates by 50 basis points today rather than 25 basis points? It's a bit difficult. Like I said, you have the effects of Russia-Ukraine conflict having an effect on inflation, but we're out of the European Union in the UK, and we don't have the support to be able to get grain exports or get grain exports imports into the UK like other EU member countries can do, or the extra support that we could get from the European Central Bank if we needed it. That's not there. So we're in a catch-2 situation where inflation is very, very high, and we need to kind of take action, all the tough decisions, as Peel puts it, to try and rein in that inflationary pressure without causing a recession or without leading consumers from and UK consumers from being able to borrow less, or businesses being able to having to borrow at a higher rate of interest from the commercial banks. So they're in a catch-22 situation there at the moment. Scotch and Stock says they need to hike, but are they gonna is the question. I think the hike is priced in already, and they're going to do a 25 basis point hike. But the key question is whether they do a 50 basis point hike, and if they follow in the path of other central banks by giving a surprise to the market. That's going to be the key thing today, and that could be a possibility. And I'll go through what to kind of expect if that does happen from sterling. If we carry on then, so investment banks and market views. So all major banks expect a 25 basis point hike to 1.25% at a 13-year high. June 9th, you had traders adding to BV bets, and they put a 50 basis point hike in play by September. 0.75%. Just rip the bandage. That would be nuts, but you never know. Think of like a 75 basis point hike for the UK as being a 100 basis point hike for the Federal Reserve. So yeah, that would be quite big, very, very big if that happened. But June 10th, what we had seen is that UK interest rate futures priced Bank of England rate to rise to 3% by February 2023 from the 1% now. So they're continuing to expect tighter monetary policy and rate hikes to come through. June 14th, so you had money markets pricing 125 basis points of Bank of England hikes by September. So a lot of what some economists were expecting is the next 4 meetings was for a 25 basis point hike increments at those meetings. But could there be a 50 basis point hike today to kind of catch up and to get to that level? Probably get to 3% level sooner rather than later. Again, that could be a possibility, or that could be very likely, but we'll kind of hold our horses. So record fuel prices at the pump. So of course, whenever I come into work, petrol prices in the UK are at the historic highs. So over the weekend we'd seen that prices reached about £1.85 a litre, and diesel reached £1.91 a litre. Of course, fuel is, as said, very expensive and has been one of the key sticking points within the inflationary readings for other countries too, without excluding food and energy, keeping that in, and that's exacerbated the reports that we've seen, and has caused inflation to kind of skyrocket by 2% to 9% from 7% when the prior release that we had. According to AA, so they say the wholesale fuel prices, which has seen huge rise since Russia's invasion of Ukraine, has been lower than its pre-Jubilee peak for more than 10 days. But prices are still high. So businesses, although, it has been, the pressure has kind of alleviated a little bit. Businesses and those on the fuel court haven't decided to decrease their prices as of yet, which to AA is just a breakdown recovery service. If you're not sure of what AA is, it's not Alcoholics Anonymous. It's not that. But that's what they're saying, is that even then, those fuel courts are keeping their prices quite high. So this is what I wanted to kind of gauge as well with vacancies and how hot the labour market is at the moment within the UK, and whether we do see this continuation of whether we do see a potential of a wage price spiral. And what we can see here, so we're compared to the active population and the number of people being employed, you can see that peak or number of vacancies increasing, right, and the unemployment rate ticking up a little bit. So one thing to remember is that in the UK at the moment, so with there's a lot of jobs that have been created, but the labour market is very tight, i.e. we have a lot of jobs but not enough workers available, or that the wages aren't enough to attract those workers to those jobs that have been created. So you've got a lot of dormant jobs, let's say, or dead end or dead jobs at the moment, where there's jobs that have been created, yes, but no one's taking it. And in that case, what's happening is that a lot of businesses are raising their wages to try and attract those people from the labour force or the workforce within the UK. But I think that's going to be quite key as well, is that when you have a wage price spiral, that will obviously add to the inflationary pressures. Of course, if consumers have more money in their pockets, then that will lead them to spending more money. That will lead them to be able to spend more money on goods and services. Okay, and in turn, those goods being provided and services being provided will need to raise their prices in order to control the level of supply and demand. Of course, more money being pumped in, and if there is the same level, or if there is the same amount of product, that means those prices will need to go higher so they don't run out of those goods altogether. Okay, so that's one thing I just wanted to show you, is that the vacancies suggest point to a red hot jobs market, and we could see a potential increase in wage prices, although we did see a slight decline to 6.8% from the last release that we had, or the release that we had this week. So this is one key thing to bear in mind then, is where's the sentiment then? Where do the Bank of England members fall on the scale of hawkish or dovish, easing or tightening? So this was the last before the last rate decision that we had, where we had seen that Cunliffe was the only one who was on the ease, or slightly on the easing side. So -2 representing dovish, 0 neutral, and +2 hawkish. Okay, remember what I said. The more hawkish you are, the more tightening you want of monetary policy. The more dovish you are, the more loosening that you'd want of monetary policy. You can even see, so you can see here that, as said, Cunliffe was the most dovish out of the other central bankers, and of course, the central bank head, Governor Bailey himself, being at 1 here in regards to his sentiment. But overall, you can see that you're seeing that in the last release that we had, or statement, that a majority of the members were in the hawkish side on that scale there. So that was the last one. We look at the next one. Okay, so kind of go back. Back to the left, and back and to the left. So you can see that Cunliffe was the only person to kind of change his sentiment, and Man to a degree, Bank of England's Man as well. So you can see that Saunders is still the same. He hasn't changed. He's still the most hawkish member of the Bank of England. But the key point here is that Cunliffe has gone from -1 from being dovish to being neutral. Okay, that's quite key. Of course, in one of the interest rate decisions that we had, where the Bank of England was expected to raise the interest rate by 25 basis points. So, of course, where the Bank of England was expected to raise their rate by 25 basis points on the meeting on March 17th, Cunliffe was the only member to look for no change in the interest rate decision, of course, citing the Russia-Ukraine conflict. And that had caused sterling to fall and depreciate in value. And whereas in this case here, that's changed with the latest projections of where the BoE members are on the scale. So potentially what that could mean is that he's more likely to vote for a rate increase rather than looking for no change. And last time that happened, all the members voted for a rate increase by at least 25 basis points. So that's one thing to just be aware of. Now, the other thing to be aware of too is that whether or not, what is the voting going to be like for a 50 basis point hike? Okay, so the last time round we had a 6-3, where 6 members voted for a 25 basis point hike, and these 3 members voted for a 50 basis point hike. We could see that today, but considering what the Federal Reserve had done last night and what the Swiss National Bank has done today by providing the surprise, particularly from the Swiss National Bank, providing a surprise rate hike by 50 basis points, what we could see is this scale change to the point where more of the members are leaning on the hawkish side, and I think you could get a 5-4 split for a 50 basis point hike, i.e., 4 of the members looking for 50, whereas the others looking for a 25 basis point hike. But it would represent a shift in sentiment, or you could get a 5-4 split in the way of a 50 basis point hike. Okay, so you'd want you look for Peel, Ramsden, Haskell, Mann, and Saunders all to vote in favour of a 50 basis point hike, and that has happened. It has happened where there has been dissension. Of course, one of the members being Cunliffe, who was a prime example of that recently, with the looking for no change when all the bank members were expected to vote for a rate hike back in March. But again, so it could be a 5-4 split looking for 50, but at least a 25 basis point hike is expected to happen, where you'd see all 9 of the voters expecting a rate hike by 25 basis points. Okay, so let's go through the previous market reaction then, and how that reacted to the release. If I just zoom in, there we go. Apologies, I'd kind of scrolled down before the release, which I shouldn't have done, but so the rate came out there. It was as expected. Okay, and we had seen this strengthening from sterling. The key reason being is that they were expecting 8 votes in favor of a rate hike by 25 basis points, and one of them being Haskell, who was expected to be the dissenter to vote for no change. But all the central bank members voted for a rate hike by 25 basis points. Hence, you'd seen this big old move towards the upside from the bank from sterling overall. So you can see there the Euro GBP did see that sharp move towards the downside. If I kind of skip ahead, actually I just want to see what tick strike did there too. That'd be, oops. Okay, it's about 5 seconds. Just want to keep an eye on what tick strike did. And there we go. So it jumped. Yeah, So yeah, there's a lot of buying pressure that came in on there. Let's kind of skip ahead, kind of see what had happened then. So similarly to the Federal Reserve, the day before this rate decision that we had, what we had seen is that the markets, so the currency itself had strengthened, but then it kind of pulled back. Of course, it was an expected rate hike. It just seen a bigger move on the initial candle. So we kind of skip ahead. So I think it's going to be the same thing with a 25 base point hike. When we do get that today, is that we'd expect a similar move in sterling to see some strengthening, but then to see that kind of not last too long and pull back and trade in the opposite direction. If I kind of skip ahead a bit more and see that, whoops, let's go back. There we go. GBP USD, yeah, still the rate decision happened, and that was it. So there's that little blip, and that was it. It was done. Now, if we get actually, let me show you the deviations first before I kind of move on. So, Bank of England. Here we go. Excuse me. Oh, I was looking at the Bank of Canada. I was wondering, why does it say 1.5? There we go. Bank of England. There we go. So there we go. So the so sterling on the first candle was flat, but the initial move that we had seen going from wick to wick, so we'd seen about 36.5 pips move towards the upside, and about 4.5 pips down, and then after about 10 minutes, we were 68.5 pips down. Euro GBP after on the first candle we were 5 pips up. And then we'd seen that initial 17.5 pips down, and after about 10 minutes is what should be in brackets there. We had seen about 43.5 pips up after that rate decision, after 10 minutes of that rate decision. And then GBP CAD, we'd seen about 5 pips down. 35 pips up on the initial reaction, and 5 pips down, and then after about 10 minutes had seen quite a strong move of about 87 pips towards the downside after about 10 minutes. GBP JPY, we'd seen 44 pips up and then 2 down, so there was a stronger initial reaction on GBP JPY compared to Euro GBP or Euro GBP dollar or cable on the initial reaction. Swiss franc was, we could probably say, had the weakest second weakest reaction compared to the others. So of course Euro GBP had the weakest reaction, and then GBP Swiss franc. FTSE 100 has seen about 20 ticks down and then 3 ticks up, and it was 30 ticks up after about 10 minutes of trading, and on the first candle it was 1 tick up. GBP New Zealand dollar, which had seen the biggest move after about the biggest initial move, and also after about 10 minutes of trading too. So we'd seen about 43 pips towards the upside and 98 pips down after 10 minutes of trading. GBP Aussie dollar seen about 44 pips towards the upside, so slightly stronger reaction compared to a similar reaction to GBP New Zealand dollar, and about 3 pips down. And then after about 10 minutes it was 87 pips down. But the key thing there, sentiment, was that markets had priced it in already. So that's why you didn't see the sustained strength on sterling towards the upside, because there was no surprise. There was nothing new, or there's nothing breaking or there was no huge in the change of sentiment of what the Bank of England was feeling or is feeling was feeling at that time when they raised the interest rate decision by 25 basis points. So I think the only thing would have helped cable and sterling, should I say, helped sterling strengthen a little bit more in the initial reaction was the Haskell actually voted for a 25 basis point rate hike compared to his prior meeting, where he looked for no change instead. So today then, dun 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 dun. So today I think we just want to be kind of cautious of what to expect. I think one thing we need to know is that with a potential for a 50 basis point hike, no new market pricing has come through on that yet. Just to make everyone aware. But I think the key thing to remember is that if we do get a 50 basis point hike, this is what we'd expect from the markets. So now with the Federal Reserve yesterday, they did a 75 basis point hike. So you'd seen the dollar see an uptick on the initial reaction, and then because a lot of people were pricing in or looking for a 75 basis point hike that had mostly been priced in, then you'd seen that move towards the downside on the initial candle. But after about 10 minutes of trading, we did see that the dollar yen particularly had seen a continuation of strengthening until Powell started making his comments about a quarter of a way through his press conference, saying that a 75 basis point hike could be possible, or a 50 basis point hike. But the key reason why the dollar had weakened is because Powell said that a 75 basis point hike is not common. Okay, so didn't cement that another 75 basis point hike was in play, basically, and that led to, I said, the dollar weakening off the back of that decision there, or off the back of that comment there, and the S&P rallied, or the stock indexes rallied again. So what I'm going to do is I'll get the. But does that kind of make sense though? So if we do get a surprise 50 basis point hike, you'd expect sterling to see a stronger reaction in the markets, potentially more of a sustained move in the markets. I.e., you might see sterling see the strong appreciation on the first candle, and then it could move back down to its pre-trading level on the same candle. And then after a couple of minutes, it could start to move back towards, it could see an appreciation again. So that's the scenario if we get a 50 basis point hike from the Bank of England. You'd expect strengthening from sterling. With a 25 basis point hike, this is, I think what could happen is you could see a little blip towards the upside. But if other central banks have taken surprise actions to tighten monetary policy, then one scenario could be that that sterling could weaken. Okay, that's one possibility. The only reason why I say that is because other central banks have followed the Fed's lead in taking aggressive action to rein in inflationary pressures, if they're seeing it as getting out of hand. So that could be one very real possible scenario where sterling does weaken if we do just get an expected 25 basis point hike and we don't get a 50 basis point hike. That would be, I think that's one possibility. But again, if we do get, as I said, if it is as expected, then expect a little movement from sterling, or little to none, a little bit of movement on the initial candle, but not too much strengthening after that. And we've seen with other central bank rate decisions as well, when the rate has been as expected, you see a little pop, and it goes back down on the first candle, and then goes in the opposite way, carries on its trading. So, yeah, is that clear for everyone? Also, don't forget, if you are listening in to me or Macro Race with your host Tony, don't forget you do have Financial Juice live now. Financial Juice live, or the pro version, okay. There is, first of all, there is no delays to the service. You don't get any adverts playing, and you're able to get real-time voice and text news straight to you, okay, which is very key for a lot of traders. The key thing is that investment banks use it as a way to manage their risk, capitalize on potential trading opportunities, and that's one thing. That's the key thing to consider, is using a Squawk service is at a very, very high level of what traders use, and who uses a Squawk service. So what we want to do is to be able to provide you with the opportunity to be able to trial Financial Juice Pro for 7 days and see what you think of it. If you've already heard me talk about it before on other in other videos that I've done, you're probably sick and tired of me. But hey, there are new people. There might be new peeps. Yeah, have a little trial of it, a 7-day free trial, and give it a go. Let me just get my screen set up. So got plenty of time. Got about 9 minutes left till we start this show. I want to get my get that out of the way. What I'll do is I'm going to get my, so as you can see, I'm going to be setting up my screens to show, whoops, if I can, okay. Yeah, so what I'm going to do is I'm going to set up my screen to show with Tick Strike. So Tick Strike allows me to listen to order flow, futures, forex, and stock instruments, but also in cryptos as well, ETFs and ETNs. There's a multitude of what we can do with Tick Strike. So that's what I'm going to get up here. Let me get GBP NZD, because that had seen the biggest move overall. The fun thing about Tick Strike 2 is I can also change the level of sensitivity. The level of sensitivity basically lets me adjust how much momentum I'm looking for. So when it's on 1 at the moment, as we can see there, you can see that it will show me an alert, or there'll be a sound alert that will play for me. Show me, of course, I've got the sound alert off at the moment. The sound alert will play for me, letting me know whether there's a buying momentum or selling momentum that's currently going on within the markets. And you can adjust that to 1 being the most sensitive to 15 being the least sensitive. Okay, and when it's at 15, you're expecting, or you're looking for a big jump in momentum or strong movements in momentum to be able to kind of capitalize on. But you can chop and change that, right? So just imagine order flow like you're in the Chicago exchange, where the guys and gals are about to shout at the market open, saying buy, sell, 122, spitting in someone's face, or budging or nudging the other person away from them because they got a better price than them. So just imagine that being translated into Tick Strike here, the order flow. So I said you can see it, you can see how much momentum that there is, and you can also listen to it as well. So what else do I want? I want my Euro GBP. So this is a little. I'll do it here with you guys. Why not? So you can see here I've got my forex. I'm just going to grab up my Euro GBP. We can grab it. Let's grab here. Put that there. Okay, I'll put it to set it to 1. Okay, let's get. I think I put GBP New Zealand dollar there. So where are we? I'm also going to put that to 1 as well. So remember, there is a 7-day free trial of TickStrike, which you can use. So I've just put it in here, chat. Okay, it's there for you. Have a little gander at that too. Have a little play with it. You can even do it for the rates today if you wanted to. if you kind of wanted to use yourself. But a lot of what traders do, if you're like a scalp trader, your average day trader, then TickStrike, some traders have said that they can kind of use it to kind of capitalize on potential trading opportunities, trade with momentum, or they use it to manage their risk as to what's going on in the markets. But again, use TickStrike however you want to use it. I'm not giving you one way to use TickStrike. There are a multitude ways you can use TickStrike, and whatever kind of works for you, works best for you, then of course do that. So also just keep an eye on the bond market too in other areas. So you can see the German 5-year bond yield extended its rise. It was now up by 20 basis points to 1.65%, the biggest daily rise since 2012. So bond yields, so usually with higher rates of interest, stocks see a depreciation in their value when currencies see an appreciation. Gilts or UK bonds, the yield would also see an appreciation with higher rate of interest, from as well. But I think with the 25, like I said, if it's as expected, you probably won't see too much of a market reaction in that case. Let's get some of the other tickers open as well. I want to see some other GPUSD. Let's get GPAUD. Good. So I'm just going to put that here for now. Oops. Okay. Here GBP is there. GBP, JPY. Actually, let's get the Aussies together. Oh no, I'll keep it there. Holy moly, markets are moving already. Trying to price in this. Well, I mean, it's already priced in, but moving already. Swiss franc. Here, level 1, the most sensitive. Alrighty, I think that's me sorted. Missing just one thing. I'm missing any. All right. Cool. Okay. Right. Okay. Let's get some of these other charts ready too. So I've got GBP CAD. And GBP CHF for Swiss franc. There you are. Funny then. we go. So, 25 base point hike as expected. 25 base point hike as expected. Seeing some movement towards the downside on GBP USD. So I think that one potential scenario that I didn't mention is that we could see a bit of weakness if we don't get a 25. BV sees CPI inflation above 9% over the next few months. What else? Inflation slightly above 11% in October. 6 policymakers voted for a 25 base point hike and 3 voted for a 50 base point hike. Okay, they didn't. MPCs Mann, Haskell, and Saunders voted for a 50 base point hike. What else? What else we got? Okay, so I think what this is confirmed is that because the Bank of England hasn't followed in the footsteps of the Federal Reserve looking for a 50 base point hike, that's the reason why we're seeing sterling see the weakness. And hopefully I did mention it, but I did mention that that could be the case. We could see some weakening if we don't see the Bank of England following in the steps of the Fed and other central banks too. Trying to see what else there is. BV says the latest fiscal measures could boost GDP by around 0.3%, excuse me, and raise CPI inflation by 0.1% in the first year. Bank of England says market implied path for a bank rate has risen materially since May. Bank of England Spady says energy and core goods account for around 8% of inflation overshoot versus target. So that's a 6-3 vote then for a 50 base point hike. But in total, everyone voted for a 25 base point hike. GDP, so Bank of England sees Q2 GDP at minus 0.3% versus 0.1% quarter on quarter in May. So okay, so they're saying weakening UK economy, or contraction in the economy. They say that sterling is particularly weak against the US dollar. Great, good thing, helping that there. Okay, just want to see. So Bank of England says that scale and pace and timing of rate hikes will reflect MPC view of economy and inflation pressure. So more or less, they haven't really factored in what the Federal Reserve did last night at all. Really, they've just stuck to their guns. Okay. Oh, okay. MPC members voted for a 50 base point hike. Said that they should lean strongly against embedding of inflation expectations. Okay. Nothing surprising or new or exciting from that report. So a dud as a 50 base point hike. 25 base point hike as expected. Didn't really give us that lovely surprise or looking for a 50 base point hike, and particularly the point that they're expecting Q2 GDP to see a contraction in the economy. So that's also helped sterling stay down. But let's take some measurements then of this market reaction here. Let's go from here. Okay, that is not. So that's about 97 pip move towards the downside. Oh Lord Jesus. Woo! Okay, that got hammered. Big time. Bailey should have gone for the 50. Then he wouldn't have got this reaction. That's about 68 pips. 68 pips up. Let's see. So as I said, GP New Zealand dollar had the GP AUD had the biggest move initially, but let's look at the New Zealand dollar too. Or the GP New Zealand dollar. Oh, Jesus. Apologies if I'm using the Lord's name in vain. Wow. That's no joke. That's 138.5 pips down. Ouch. Okay. Whoops. Let me see. And that is 126.5. Down is what I see. Yeah, 126.5 pips. Pips down. Ouch. Okay. So the biggest mover, GBP New Zealand dollar. And what else do I want to get? I want to get GBP CAD. It's kind of hard not to laugh, but of course I live here, so it's still not it's, I mean, it's great that we haven't, from a from a consumer's point of view, that we're not seeing huge hike or huge unexpected hike in the morning. But so 117.5 pips down. GBP Swiss franc. Oops. That's about 900. Excuse me. That's about 91.5 pips. Yeah, down. Okay, what else do I need to cover? I got GBP New Zealand dollar. I got the Euro GBP. Got GBP Swiss franc. GBP CAD. GBP dollar. Cable. What else do I need to cover? What else? I think that is it. Those are all the ones I need to kind of cover. Paul Santos says UK will struggle through the winter. Will like to follow on their excuses when asked what could they have done better. Yeah, a little bit of pain. Well, it depends now what the next inflation reading is going to be now, for the UK. But the next 3 inflation readings. Of course, it takes a little bit of time to kind of rein in those inflationary pressures. It's not like an instant thing, but yeah, if they do continue to rise and soar after the next couple of inflation readings from the UK, or next 2 or 3, then it's not looking great for the UK, and also for monetary policy either. Okay, so just to highlight then, just to summarize, so the biggest move, kind of what we'd seen last time, or basically what we'd seen last time. So GBP New Zealand dollar had the biggest move. Then we go GBP Aussie dollar, and then we go GBP CAD, Swiss franc, GBP USD or cable, and then Euro GBP. Sorry, should be GBP USD, then Swiss franc, and then finally Euro GBP. Okay, so one thing to bear in mind, if you did like this video and it's something that it's helped you, or you found it useful to kind of listen to and watch out for, then don't forget to follow us on Twitter and also the mailing list. So the deviations then that you see there, that are shown you here from on the page. This is something that our subscribers get every Sunday, in a bit more detail as to, of course, there are other releases that I covered too, not just the Bank of England, but you've got a plethora of different major releases that see market or big market reactions. The key thing for macro race is to kind of tell you what's going to see, which release is going to give you the biggest moves. Okay, And where is that big move likely to happen the most? So that, of course, that's one part of macro race that we provide on Sunday, and the rest of the key point being that on Sunday I provide this. Oops, if I get that out of the way, provide a week ahead of what to expect. So the releases that we'll be covering, the week ahead for Asia, for Europe, what to kind of expect, and also for the US, and then a summary of the weekend news as well. So again, a lot of detail for you guys that I put together for you on a Sunday, that and that is sent out on a Sunday during the day or in the evening for you guys to have a look at. So what you can do is you can subscribe to the mailing list to be able to get that. Also, what's also included in that email as well is the week ahead videos or live streams that I put together into a playlist, and then also the previous releases as well that are already in a playlist that are also attached for you, so you can kind of gauge how the markets reacted as well in the replay. But ladies and gentlemen, thank you very much for jumping on and listening to Macro Race's Bank of England decision prep. Of course, just to go over it again then, so Bank of England wasn't aggressive enough. Wasn't aggressive enough to go for a 50 basis point hike. Stuck to its 25 basis point hike. Sterling weakened overall, and the Bank of England could be in trouble. That sucks because I'm here. But yes. Thank you very much, Scotch and Stocks. Hope you have a good rest of the day too as well. Thank you very much, and sayonara. Goodbye. Enjoy your weekend too. And that's it. That concludes Macro Race for the week. Remember, Sunday I'll post out the week ahead prep for you. Oh, excuse me. One more thing that I forgot to mention is also our unusual activity beta test that we're doing, which at the moment has free access, which will allow you to trade. If you wanted to trade unusual volume activity in stocks, then you can get that and look at the unusual moves that are happening within the stock market. So when we're talking about unusual activity, is that stock moving? If we're thinking about the 99th percentile, what is the unusual move that it's seeing? If it's seeing a pickup in volatility, you still can't access it for some reason. Okay, if you email Amar at financialjuice.com, and he can try and sort it out for you. Apologies, that's appreciate your patience with it too. But yeah, so there you go. So there's Amar at financialjuice.com. Unless you've already emailed him. But if you haven't, then it's there for you to be able to do that. So as I said, the link is already there. If it isn't working for you, then just email Amar. He's got a ton of emails. But as usual, hey, customers come first. All right, I'll see you next time. Take care. Bye now.